Last week, we got one of the largest job revisions downward that we've ever seen. In fact, it was the biggest downward job revisions we've had since 2020, which is not exactly a year you want to be comparing to. The Dow Jones estimate for job growth in July was 100,000, yet it came in at only 73,000. Now, that alone would have been enough to probably somewhat move the markets, but it was the revisions to prior months that really made the market start to fall off a cliff last week. Between June and May combined, the total jobs were revised downward by a combined 258,000 jobs. And you can see here by the chart that left June with only 14,000 jobs and May with only 19,000, which means after the revisions, June and May had basically zero job growth. And in fact, every single month this year has had downward revisions so far, leaving 2025 year to date with negative 461,000 jobs in total downward revisions. Compare that to 2024, which had negative 625,000 jobs total for the full year, and 2023, which had downward revised 369,000 jobs again for the whole year. We're only halfway through 2025, and we're already at a downward revision of 461,000 total. If you were wondering why the market started to sell off last week, and potentially as you're watching this is continuing its move down, this is the reason why. Uneasiness and uncertainty about the strength of the economy due to there being far fewer jobs than people thought there were before, because apparently people have just been trusting government data this whole time. Now, if you pull apart the data, it's actually not quite as bad as it sounds on the surface, and here's why. Most of the job revisions came from government jobs. In fact, for this entire year, most job growth that's been reported has been government jobs. But if you take a look at this and you see most of the jobs being revised downwards were government jobs, this is actually a really healthy sign for the economy. Every single dollar that gets transferred to the government through taxes or borrowing is a net drain on productivity and wealth. Every job that is a government job costs the economy money, which means the fewer government jobs there are, the wealthier everybody else will be. And no, it doesn't even matter if total government spending doesn't go down. Hypothetically, let's just say every single person who is currently employed by the federal government just ceased to exist or lost their jobs or got fired, but the government somehow kept on spending the exact same amount of money, there would still be a lot more wealth left over for the private economy because you wouldn't have all those people in there making it harder to do business. You wouldn't have all those unelected bureaucrats imposing their ideas and opinions on the rest of us. So as far as I'm concerned, the more downward revisions we get in government jobs, the better. Now, if we pull apart the data a little bit more, it shows something else that is pretty interesting. I'm not going to share my opinion about this because it is a highly contentious political issue right now. But if you take a look at job growth and declines with native-born workers versus foreign-born workers, most of the revisions down were from foreign-born workers. And in fact, job growth among native-born workers in the private sector has actually been very, very strong this year. If you want a strong economy, you need as much good immigration as possible and as little bad immigration as possible. I'll leave it up to you to interpret what good and bad means. So overall, when you look at the last couple of years, the monthly job creation numbers have been on a downtrend. Recently, a lot of that has been from government workers, which is a good sign for the economy. However, not everybody is looking at this as a good sign. In fact, overall, the market is interpreting this data as it's very negative. Also, President Trump is very upset about this. I'm not sure whether he's more upset about the fact that there were incorrect numbers being reported before, or whether he's upset about the fact that the numbers are being revised so much lower now to accurate numbers or more accurate numbers. Either way, he was so upset that he decided to fire the commissioner of labor statistics at the BLS after these new revised figures were released. Because again, it wasn't just this month that came in lower, and it wasn't just the last couple of months that were revised lower. It was literally every single month for the entire year that was revised lower, to the point where we are now sitting at an downward revision of 461,000 total jobs. The BLS is saying that the reason why this data is getting worse and worse is because a smaller share of firms are responding to the first polls. Initial collection rates have repeatedly slid below 60% in recent months, and they're saying that the more data you're missing and that data comes in later, the higher the odds are that the revisions will be much larger. The problem with this is that the numbers are always revised to the downside. They're never revised up, which means there's some bias built into the estimates or into the modeling when they put these data points that they do get into the estimates that biases jobs reports being much higher because they're always revised downward once more data comes in. So it's possible that Trump is just upset at the messenger and he wants somebody who will give him better news. It's also possible that this causes some sort of a turnaround in the data collection and we get more accurate job data, although we'll see. In addition to the stock market selling off, we also saw a plummet in yields. Like the 1-year treasury went from over 4% down to about 3.8%, and the 2-year went from just under 4% down to 3.6%. This is the market signaling that they now expect the Federal Reserve to cut interest rates because of weakness throughout the general economy, especially because the longer end of the curve, like the 30-year treasuries, did not experience as much of a drop in interest rates as the short end did, which is the one that the Federal Reserve has most influence over when they cut the federal funds rate. Add on to that third-party measures of inflation are also starting to quickly decline, like Trueflation is showing that US inflation is only at 1.67% year over year. And you start to get the feeling that these downward revisions in jobs may actually end up being bullish for asset prices because of the flood of money printing that might be coming. But it's not just market expectations. There's one more little twist here that means we could be getting interest rate cuts very soon. And that is that Adriana Kugler, who is a governor on the Federal Reserve Board, has submitted her resignation effective August 8th. In the last FOMC meeting, when the Federal Reserve voted and decided on whether or not they were going to cut interest rates, there were two who dissented and said, we want to cut interest rates. Everybody else said, no, we're gonna hold them steady. Now, most of the time, there's nobody who dissents. If there's anybody who dissents, it's one. This was the first time that two governors dissented since 1993. And the two who dissented were Waller and Bowman, which means that Kugler was not one of the ones who wanted to cut rates. Kugler was one who voted to hold rates steady. And now Governor Kugler's resignation gives Trump's a nominee on this committee that sets interest rates. We all know that Trump has been pressuring Powell for months now to lower interest rates. And now that inflation numbers are changing, now that jobs numbers are severely changing, and most importantly, now that the bond market is starting to front run this, with the short end of the curve starting to fall, it seems very likely that the Federal Reserve cuts interest rates at their next meeting. Now, when unexpected news happens like this, if it causes you to panic, you're looking at your account wondering, should I sell everything? Should I buy the dip? That means you are not prepared. If you don't have the proper allocation in cash, in hard assets, in stocks, and also have hedges in place when the timing is right to take advantage of moves like this, and most importantly, so that you can buy world-class assets when they're on sale and you know what price they need to be at for them to be on sale. You're not just looking at, oh, it dropped by 5%. If that doesn't sound like you need my Hypergrowth Portfolio Blueprint. It gives you a step-by-step guide to protect you from exactly what's going on right now, and so that it sets you up to profit, create wealth for the long term that lasts. It's linked in the description below. Get it now while it's on sale. As always, thank you so much for watching. Have a great day.